gentlemen, welcome to the 15th KIEP-IMF Joint Conference. My name is Jian Lee and I'm from KIEP. Today's conference is titled 2026 World Economic Outlook, Rapid Slowdown Amid an Asymmetric World. The program will proceed as follows. We will begin with opening remarks by the President of KIEP, Dr. Seok Lee, followed by a brief photo session. Then we will have two main sessions. Session 1 will cover the world and Asian economic outlook for 2026, and Session 2 will focus on the Asia's value chain and its implications, followed by a panel discussion with our speakers. We hope you will stay with us until the end. Now, I would like to invite Dr. Seok Lee, President of the Korea Institute for International Economic Policy, to deliver his opening remarks. Please welcome him with a warm round of applause.
Good afternoon, honored guests, ladies and gentlemen. It is a great pleasure to welcome all of you to today's conference. First and foremost, let me express my deepest appreciation to our session chairs, speakers, and the discussant for joining us at the 15th KIEP-IMF Joint Conference. I am especially grateful to Dr. Sakai Ando and Dr. Chikako Baba of the IMF's Asia-Pacific Department for their extensive support and close cooperation in making this event possible. As we look ahead to 2026, the global economy continues to navigate an increasingly complex and uncertain landscape. The reconfiguration of global value chains, shaped by both the economic force and the shifting geopolitical realities, has become a defining feature of the current international economic environment. At the same time, an exceptional surge in AI and technological-related investment has emerged as a key driver supporting growth, even as trade tensions and policy fragmentation persist. Over the past year, the global economy has once again demonstrated a remarkable capacity to adjust. While new tariffs and non-tariff barriers have generated significant headwinds, a range of buffering mechanisms, such as supply chain reorganization, export market diversification, and the acceleration of technological investment, has helped to absorb these shocks and avert a steeper downturn. Yet this adjustment process has also produced highly uneven outcomes across countries, sectors, and firms, reinforcing concern about the divergence and inequality. According to the World Economic Outlook released by the KIEP in November, global growth is projected to reach the 3% in 2026, broadly in line with the modest pace expected for this year. KIEP has characterized this outlook as a buffered slowdown in an asymmetric world, reflecting both the resilience provided by these buffering mechanisms, but at the same time, the growing heterogeneity in growth performance. For Asia in particular, 2026 will be a year of both significant opportunity and considerable challenge. The ongoing restructuring of regional value chains offers the scope for deeper economic integration, productivity gains, and new comparative advantages. At the same time, this transaction entails a substantial adjustment cost, as well as demanding requirements for policy coordination, institutional upgrading, and the social support within and across countries. Downside risks to the outlook are also non-trivial. These include, first, abrupt shift in the evolving tariff and trade regime. Second, eroding fiscal space and diminished crisis response capacity after years of elevated deficit and rising public debt. Third, heightened concentration risk stemming from geographically and sectorally across the AI and the technological investment. And last, not the least, uncertainty associated with China's ongoing economic transition and its potential for the significant regional spillovers. Against this backdrop, session 1 of today's conference will focusing on the global and the Asian economic outlook for 2026, discussing the key trends, uncertainties, and the policy challenges confronting the region. The second session will turn to Asia's evolving value chains and explore the implication of this transformation for the region's long-term growth, resilience, and economic architecture. A deeper understanding of these dynamics is essential as policymakers, researchers, and market participants seek to navigate an increasingly complex and fragmented global environment. In this context, the insight and perspective shared at today's conference will be invaluable. I'm very much look forward to the thoughtful analysis, rigorous debates, and the constructive exchanges that will take place throughout our discussions. Once again, I would like to thank all the participants and the audience for joining us today. Thank you very much.
Thank you, President Lee. Now we will have a photo session. Speakers and panelists, please come forward and gather on the steps in front of the podium. Thank you. We will now begin session 1, World and Asian Economic Outlook for 2026. This session will be moderated by Professor Tae-Suk Kang from the Korea Advanced Institute of Science and Technology, KAIST. Professor Kang, the floor is yours.
Good morning. Good afternoon, sorry. Well, it is my hugely honored and privileged to be here as an alumni of KIEP. And today's topic is World and Asian Economic Outlook for 2026. It was a prime platform for a joint conference between KIEP and IMF. It was a good tradition already. This is the 15th conference here, so I'm very proud of that. And I would like to introduce the two speakers. And Sang-ha Yoon is the Executive Director, International Macroeconomics and Finance Department of KIEP, and Mr. Sakai Ando, Economist, Asia and Pacific Department, IMF. And we have a 20 to 25, each presenter has a 20 to maximum 25 minutes of presentation. And after that, we will open the floor for you for the discussion. So I would like to introduce first Mr. Sang-ha Yoon for his presentation.
Good afternoon, everyone. I'm Sang-ha Yoon, the Executive Director of International Macroeconomics Finance Department at Korean Institute for International Economic Policy. It's a great pleasure and honor to have a chance to present 2026 World Economic Outlook in front of the distinguished audience. Let me briefly outline today's presentation. It consists of 4 parts. First, I'll provide an overview of the 2026 global economic outlook, including our growth projections, key themes, and risk factors. Second, I'll discuss developments in global financial and commodity markets, which includes interest rates, exchange rates, and oil prices. Third, I'll cover the economic outlook for major economies, advanced economies such as the United States, Euro area, and Japan, as well as emerging economies including China, India, and ASEAN 5 countries, and so on. And finally, I'll conclude with a summary and closing remark. Now, let me begin with an overview of the global economic outlook. So, KIEP projects global economic growth of approximately 3.0% in 2026, the same rate as our 2025 forecast. This suggests that the moderate growth trends we were seeing this year will continue into next year. In historical context, the growth around 3% is relatively subdued compared to the 2000s. Setting aside exceptional crisis periods, the global economy remains in a phase of weaker growth compared to the past. That said, conditions have improved somewhat from our May forecast. The 2025 global growth rate was revised upward, reflecting stronger than expected performance through the third quarter in the United States and other major economies. Despite tariff shocks, the global economy has proven more resilient than initially anticipated. Nevertheless, overall growth remains modest for both 2025 and 2026, indicating that the world economy continues to face structural headwinds. Looking at country-level projections for 2026, the United States is expected to grow at 1.6%, Euro area 1.1%, Japan 0.6%. In contrast, China is projected at 4.2%, India at 6.5%, and ASEAN 5 countries at approximately 4.7%. While emerging markets are generally outpacing advanced economies, growth momentum varies significantly across countries. The relatively subdued performance of the US, Europe, Japan, and China is weighing on the global average. Compared to our 2025 May forecast, we've made some adjustments. Overall, we've slightly revised up our global outlook. The 2026 global growth rate has been raised by 0.1 percentage points from 2.9% to 3.0%. This reflects the fact that the impact of U.S. tariff policies was more contained than initially feared, and that domestic demand and exports in major economies proved more resilient than expected. However, I should note that our 2025 forecasts were also revised upward for most countries, which raises the base for comparison. For instance, the U.S. growth forecast for 2026 remains at 1.6%, but since we raised our 2025 projection from 1.3 to 1.8%, the underlying trajectory has improved. Similarly, for China, we revised both years upward from 4.1 and 4.0 to 4.8 and 4.2. So rather than simply comparing 2026 figures horizontally, it's more appropriate to interpret this as an overall improvement in the growth trajectory. When comparing 2025 and 2026 growth rates to the pre-pandemic average of 2015 to 2019, most major economies fall well short. For the US and Euro area, growth was around 2% before the pandemic, but now hovers near 1%, a gap of roughly 1 percentage point. A similar pattern holds for emerging markets, albeit to varying degrees. China once grew at 6.5% or higher, but is now projected in the low 4% range. In contrast, India and the ASEAN 5 countries have nearly returned to their pre-pandemic growth levels. This highlights that while successive shocks and structural factors have pulled down the global growth trajectory, the impact has been uneven across regions and sectors. For reference, let me briefly touch on how projections from the IMF and OECD have evolved over time. Similar to KIEP, both institutions initially lowered their 2025 and 2026 forecasts only to revise them back up recently. For example, the 2025 global growth forecast was around 3%, 0% or higher last year, dipped to the high 2% range mid-year, and then has recovered to around 3%. This reflects the adjustment process following the tariff shock, as well as upside factors such as trade diversification and the AI investment boom. Currently, major institutions are converging on growth forecasts of around 3% for both 2025 and 2026. Let me elaborate on this adjustment process. The chart on the left shows the U.S. effective tariff rate rising sharply in 2025 as the U.S. expanded the scope of tariff measures, raising tariff barriers and putting downward pressure on global growth. On the right, we see a surge in private investment in AI globally, particularly in the United States. This investment boom in AI-related infrastructure is helping to offset declines in manufacturing output and trade. Additionally, supply chain restructuring, export market diversification, and margin absorption by firms have all helped cushion the economy. In summary, while global economy is a slowdown phase, these adjustment mechanisms have prevented a sharper downturn. The key theme for the 2026 global economy can be summarized as buffer slowdown amid an asymmetric world. The global economy is clearly in a slowdown phase, but supply chain reconfiguration, export diversification, margin absorption by companies, and expanded tech investment are acting as buffers, preventing a steep decline. At the same time, conditions remain highly asymmetric across countries and sectors. Despite these buffers, significant downside risks remain. Let me highlight three key risks. First, tariff order upheaval. Uncertainty around U.S. trade policy has already elevated tensions in global trade. If current agreement unravel and we see a renewed cycle of tariff escalation and retaliation, global trade and investment could contract sharply. Higher tariffs would raise import costs, fuel inflation, delay monetary policy easing, and further suppress global demand. Second, weakened fiscal space. Many countries have accumulated significant debt during the pandemic, and fiscal deficits continue to grow due to defense spending, aging population, and industrial transitions. This limited fiscal room could constrain government's ability to respond effectively to future crises. Third, investment concentration in AI and tech. The technology-led stock rally has boosted household wealth and supported consumption in the United States and elsewhere. However, market concentration in a few tech giants poses risks. Any shock to these firms could trigger broader market volatility and potentially spill over into real investments and consumption. Now let me turn to global financial and commodity markets. Starting with interest rates, the Federal Reserve have begun cutting policy rates amid the labor market concerns, but the pace and direction of monetary policy remain uncertain. Tariff uncertainty, potential inflation resurgence, and widening fiscal deficit and declining confidence in the U.S. Treasuries could push long-term yields higher. On the other hand, employment weakness, federal fund rate cuts, and safe haven demand for treasuries could exert downward pressure on yields. We expect U.S. Treasury yields to trend lower, but with elevated volatility as these opposing forces play out. In Europe, bond yields are edging up due to slower disinflation and fiscal concerns, even as the European Central Bank continues its gradual rate-cutting cycle. In Japan, inflation, fiscal expansion, and weak demand at bond auctions are keeping upward pressure on yields. And these developments in major economies will have implications for global capital flows and emerging market volatility. Turning to exchange rates, the US dollar itself is expected to weaken gradually against major currencies as US growth slows and the Fed continues easing. However, trade policy uncertainty, safe haven demand from geopolitical risks, and potential limits on Fed easing due to tariff-driven inflation could all curb dollar weakness. Overall, we expect a modest depreciation, though the pace may be tempered by these factors. For the Korean won, we expect moderate appreciation supported by Korea's inclusion in the World Government Bond Index, improved asset appeal, and strong semiconductor exports. That said, increased overseas portfolio investments by Korean households, institutions, and pension funds could partially offset one's strength. On oil prices, we see downward pressure as the dominant trends due to ample supply and softening demand. OPEC Plus is scaling back earlier production cuts, effectively shifting toward expansion. U.S. crude output remains at record highs, and major oil companies are expansion mode. On the demand side, global growth slowdown is dampening oil consumption. China's recent uptick in oil demand was largely base effect driven and is expected to moderate. Of course, short-term volatility risks persist. Geopolitical tensions in the Middle East and the U.S. sanctions on Russia and Iran could push prices higher, while recession risks and weaker Chinese demand are downside factors. On balance, supply conditions appear adequate, so we expect oil prices to remain relatively stable. Now let me discuss the outlook for major economies. Starting with the United States, we project US growth rate at 1.6% in 2026, down from 1.8% in 2025. The slowdown reflects the labor market softening and weaker consumption. Key indicators, rising unemployment, slowing payroll growth, and lower employment rates have shown signs of deterioration. Consumption has remained resilient, but sentiment is weakening due to labor market concerns and higher prices on tariff-affected goods. On the positive side, numerous AI and data center investment plans are being announced. Smooth execution could support growth through private investments. However, downside factors include potential Section 232 tariffs and the impact of government spending cuts. For the euro area, we project growth of 1.1% in 2026, unchanged from 2025. Trade tensions dampened export and investment in 2025, but wage gains and public investment through the EU's Recovery and Resilience Facility helped support domestic demand. Inflation stabilized around the 2% target, prompting the ECB to embark on a year-long gradual rate cut cycle. In 2026, we expect a gradual recovery in consumption and investment, supported by price stability and easier financial conditions. Expanded defense spending is another positive factor. However, political uncertainty, fiscal concerns, and weak external demand will cap the upside, keeping growth at the same level as 2025. Japan is projected to grow at 0.6% in 2026, down from 1.1% in 2025. The main headwind is external sector weakness. U.S. item-specific tariffs and reciprocal measures have weighed on Japanese exports and production. From January to August 2025, exports to the U.S. declined YOY, with transport equipment particularly hard hit. Private consumption has held up reasonably well, but elevated inflation has eroded real wages, limiting spending growth. Fixed investment may face downward pressure, though stabilizing prices should help support consumption. Growth also depends on whether the new cabinet's expansionary stance, focused on crisis management investment and strategic fiscal policy, is maintained within the coalition. China is projected to grow at 4.2% in 2026, down from 4.8% in 2025. This year, the Chinese economy benefited from moderate exports, consumption stimulus, and policy-led increases in fixed investment. Tariff impacts were limited thanks to U.S. deferrals and export diversification. Measures such as consumption vouchers, tax cuts, and equipment replacement programs have shown clear effect. However, weakness in the property sector continues to deepen, and soft employment, weaker domestic demand, and intensified price competition are pushing prices lower. For 2026, key upside factors include ongoing consumption stimulus, equipment modernization, manufacturing upgrade, and easing of tariff tensions. Positive effects are also expected from the fifth five-year plan. However, risk persists from the property downturn, weakening local government finances, and potential renewed U.S.-China tensions. India is projected to maintain 6.5% growth in 2026, the same as 2025. Strong domestic demand is the key driver. In the first half of 2025, India recorded solid 7% growth, supported by robust private consumption and higher government spending, while inflation remained stable within the central bank's target range. India is already also relatively insulated from the U.S. tariff policies. Goods exports to the U.S. amount to only 2% of GDP. The government is strengthening its self-reliant India initiative to mitigate tariff-related uncertainties, enhance household purchasing power through GST reforms, promote domestic consumption campaigns, and diversify external ties through the economic cooperation with major partner countries. The ASEAN 5 countries are projected to grow at 4.7% in 2026, maintaining their stable trajectory. Strong domestic demand and resilient exports have supported growth despite U.S. Reciprocal tariffs. These economies are diversifying partnerships amid tariff uncertainty. Country by country, Indonesia is expected to grow at 4.9%, as solid private consumption, supported by expansionary fiscal and monetary policies, cushions export weakness from China's slowdown and U.S. tariff measures. Malaysia's growth eases to 4.3%, with high trade dependence leaving it vulnerable to external uncertainty. The Philippines is projected at 5.5%, supported by low inflation and solid consumption. Thailand is expected to remain low at 1.7% due to subdued exports, weak consumption, and tourism, despite active stimulus efforts. Vietnam stands out with high growth of 6.7% as proactive export shipments and resilient domestic demand help cushion the impact of bilateral tariffs. Russia's growth is projected at just 1% in 2026. After growing only 1.2% in the first half of 2025, the economy slowed sharply to 0.6% in quarter 3. Several factors are driving this deceleration. Consumption and investments have weakened following policy rate hikes in the late 2024 to curb inflation. Ongoing sanctions on the energy sector and lower oil prices have reduced fiscal revenues and investment capacity. Prolonged sanctions, economic contraction, persistent high interest rates, and energy sector constraints continue to weigh on growth. Structural factors including labor shortages, supply chain constraints, and stagnant productivity have accumulated, leaving Russia with limited growth prospect. Finally, Brazil is projected to grow at 1.8% in 2026. The economy is constrained by very high interest rates. The policy rate remains at 15%, driven by low unemployment, elevated inflation expectations, and tariff policy uncertainty. This is weighing heavily on domestic demand. Government debt is also increasing as fiscal spending rises on industrial policies, large-scale infrastructure improvements, and relief measures for tariff-affected firms. With the presidential election scheduled for October 2026, the government is likely to maintain its expansionary policy stance. However, U.S. tariff policies toward Brazil, including high tariffs on agricultural and livestock exports, constitute key downside risks. Having covered all major economies, let me now conclude with a brief summary. Global growth is projected at 3.0% in 2026. The key theme, buffered slowdown amid an asymmetric world, reflects how supply chain reform configuration, export diversification, margin absorption, and expanding tech investment are cushioning trade-related downside pressures. Downside risks include tariff order upheaval, weakened fiscal space, and investment concentration in AI and tech. Interest rates are expected to edge lower, a dollar weaken modestly, and oil price to face mainly downward pressure, though uncertainties remain across all areas. Four major economies, the United States is at 1.6% with soft labor market conditions, weaker consumption, and reduced government spending. Euro 1.1%, Japan 0.6%, and China at 4.2%, backed by government stimulus but facing slowing momentum. India leads at 6.5% and ASEAN 5 countries at 4.7%. On the other hand, Russia only 1% growth project and Brazil at 1.8%. So in summary, the 2026 global economy will exhibit a buffer slowdown with asymmetric growth patterns across countries and sectors. Given limited policy headroom, international cooperation and proactive external risk management will be more important than ever. This concludes my presentation, and thank you very much for your attention. Thank you.
Well, thank you, Dr. Yoon, for your wonderful and composite outlook for the world economy next year. Next, we have Sakai Ando, Mr. Ando, for his presentation, Navigating Trade, Headwinds, and Rebalancing Growth. You have 20 to 25 minutes, please.
Thank you for the opportunity to present the Navigating Trade Headwinds and the Rebalancing Growth. This is the conjunctural chapter of the Regional Economic Outlook, October. I'm Sakai Ando from the IMF. Let me begin with the key takeaways. Regarding recent developments, the growth in the first half of 2025 has been robust, supported by strong exports, a buoyant tech cycle, and the policy easing. Early evidence points to rising intra-regional trade and the continued reconfiguration of supply chains. Domestic demand remains soft in most countries despite macro policy support and recent recovery. Inflation is soft and at or below targets across countries in the region. Financial conditions have eased, aided by improving sentiment and declining yields in emerging markets. Exchange rates mostly held up against the dollar, but appreciation against the dollar hasn't led to effective exchange rate appreciation in emerging markets. For the outlook and the risks, growth is expected to remain steady in 2025, but slow in 2026, with inflation staying soft. Risks are tilted to the downside, especially if trade tension re-emerges, social tensions escalate, or financial tightening and the risk of shocks hit the region. On the upside, the strong AI cycle and the policy support could boost growth. Regarding policies, macro policy support to cushion the impact of trade shocks and support the domestic demand is needed to help Asian countries navigate the challenging global environment. This includes monetary policy easing and temporary fiscal support in some countries. Structural reforms to build resilience are essential, including those to reinvigorate productivity growth, demand rebalancing, promote regional integration, and improve policy frameworks. Before going into the details, let me mention a sovereign economic and social political backdrop for Asia. The Asia-Pacific region has been an engine of growth for the world, but growth has slowed in recent years. Recent developments have sharpened some of the challenges. On the left, the trade has long been a source of strength for the Asia-Pacific, but it has become a potential vulnerability as the tariff shock hits the region. US tariff announcements on April 2nd led to unprecedented levels of trade policy uncertainty, with Asian economies hit hard by the initial tariffs. While the initial tariffs were soon paused and the preliminary trade deals were reached with many economies, tariff rates are well above those last year, and uncertainties are still high. On the right, the trade shock put pressure on existing structural headwinds. Slowing regional demand, structural bottlenecks, and the rising socioeconomic tensions have weighed on the economy. Rising youth unemployment amid the demographic shifts and dissatisfaction with the political leadership have fueled social strains in several economies. Against this sobering backdrop, I'll focus on the key takeaways of the economic assessment. To begin with the recent development, growth was resilient in the first half of 2025, despite the tariff shocks, supported by robust exports and policy easing. The green positive bars are the contribution from net exports. Other colors combined are domestic demand. Exports and consumption improved in many economies. On the right chart, the resilient growth was a positive surprise in many economies compared to the reference scenario in April 2025 economic outlook. In external sector, exports are strong despite the waning of their front loading. So the exports to the US have slowed, suggesting front loading is waning, but the Asian exports overall have remained strong. On the right chart, export strength is supported by intra-regional trade and a buoyant tech cycle. Intra-regional trade has been particularly strong. China's exports to countries in the region was strong, in part reflecting the strong supply chain trade. This is, however, not the single driver of the regional trade. Intra-regional trade outside of China also picked up strongly, led by tech exporters. Driven by a global investment boom and related demand for Asian tech products. Asian emerging economies, particularly ASEAN, also increased their sales to China. The recent intra-regional trade patterns point to continue the reconfiguration of supply chain in the region. On the left chart shows that the trade diversification is shaping regional export patterns. Since earlier this year, China has increased its exports to the ASEAN, while its exports to the US have declined. And ASEAN countries have increased their exports to the US. These changes are not new. Supply chain reconfiguration have been taking place since 2018, driven by initiatives to deepen trade relations and the relative cost advantages of different countries. On the right, consistent with the story of continued supply chain reconfiguration, FDI to ASEAN has stayed strong. The announcement of future investments suggests that companies continue to pursue supply chain diversification in the region. That was external sector. Domestically, the domestic demand has remained soft despite policy support. The left chart shows that the consumer confidence has been improving recently in a few economies, but is still below pre-pandemic levels. In the middle chart, the weak domestic demand partly reflects cyclical and structural factors. In emerging markets, persistent weakness in the service sector, particularly those related to travel, transport, and accommodation subsectors, have been a headwind to job and income growth. The middle chart illustrates this point by showing the deviation from the pre-pandemic trend. Relatedly, tourist arrivals in Asia have recovered more slowly than in other regions and are still persistently below the pre-pandemic trend. On the right chart, another potential driver, high household debt and the downturns in the housing cycle, for example, in Thailand, New Zealand, and China, have also dampened the consumer demand and the construction activities in some countries. We have discussed the external and the domestic aspects of the economy. Let's touch on the financial aspect. Financial conditions have loosened across advanced economies and emerging markets with compressed term premiums in emerging markets. On the left chart, the financial condition eased after a brief spike in April. Corporate spread narrowed, and like in the rest of the world, equity prices rallied. Depreciation in nominal effective exchange rates is another driver of loosening financial conditions. The biggest driver is a declining 10-year government bond yield. Zooming in on the 10-year government bond yield in the middle chart, the term premium in Asia AE, which is black line, and the US in yellow line, all increased in 2025, but the term premium for Asian EMs have been declining. This is consistent with the weak domestic demand and expectations of low inflation and low policy rates. We then study the driver of the term premium. In emerging market economies, country-specific conditions such as the local inflation prospects, FX volatility, and the domestic policy rates are the drivers to contain the term premium. Exchange rates reflect global and domestic factors. In the left chart shows that advanced Asia currencies generally appreciated against the US dollar as the latter weakened. Most emerging market currencies also held up against the dollar, but the strength has been limited by the soft domestic demand and monetary easing. The right chart shows that the many emerging market currencies in the region depreciated in both nominal and the real effective terms relative to trading partners' exchange rates. Moving to outlook and risks. We have revised the Asia-Pacific's 2025 growth upward to 4.5%. Overall, Asia's growth is expected to hold steady in 2025, with policy support and a strong tech cycle offsetting the tariff shocks. The region is projected to slow in 2026 due to softer external demand amid elevated tariffs, though the deceleration will be milder than previously anticipated. Growth in advanced Asia is forecast at 1.6% in 2025, stable relative to 2024. Though with the heterogeneity across countries, growth in Japan and Australia strengthened relative to 2024, but Korea is slowing. Growth in emerging Asia is projected to slow to 5.2% in 2025 from 5.3% in 2024, largely due to tariffs and the trade uncertainty. We'll talk about the China, India, and Japan in later slides. Pacific Island countries are projected to moderate to 2.9 in 2025 from 3.6 in 2024. ASEAN is expected to slow to 4.3% in 2025 from 4.8% in 2024. This is an upward revision relative to April 2025, thanks to lower effective tariffs, stronger demand from trading partners, and looser financial conditions. Let's dig into a few large economies. In China, growth is revised up given the strong data outturns in the first half and the tariff truce with the US, partly offset by weaker than expected investment, particularly in real estate. We now expect the GDP to grow by 4.8% in 2025 and 4.2% in 2026. This is an upward revision from the April's reference point scenario. The outlook is subject to unusually high uncertainty, with further trade policy changes and a protracted property sector adjustment posing risks. In the middle chart, turning to inflation. While core inflation inched up recently, headline inflation remained close to negative territory and slipped into negative territory in August. In the right chart, against the backdrop of deflationary pressure, the authorities recently launched an anti-involution campaign aimed at curbing intensive price wars. The August PPI data suggests the PPI deflation narrowed only slightly, and the one contributor was the marginal uptick in PPI inflation in the anti-involution targeted sectors. However, we still think the impact of the anti-involution campaign will take time to materialize. India remains the fastest growing major economy in the world. In the April-June 2025 quarter, GDP grew by 7.8%, exceeding staff projection. Private consumption growth was buoyant, thanks to increasing rural demand and stable urban demand. Investment is still supported by the public investment push, whereas private investment appears to be less dynamic. In the middle chart, for fiscal year 2025-26, India's growth is revised upward to 6.6%, supported by strong GDP growth outturn, and the goods and service tax reform despite another adverse impact of the 50% tariff. For fiscal year 26-27, growth is revised downward to 6.2% due to the adverse impact of tariffs. In the right chart, the inflation dynamics are benign. Headline inflation declined significantly in recent months, reflecting lower domestic food prices. And this food inflation has declined significantly and stayed at 0% in August, reflecting good harvest. Core inflation has increased to 4.1%, in part due to rising gold and silver prices. For Japan, growth in the first half of 2025 was robust, supported primarily by strong domestic demand. Also, adjustments in profit margins by Japanese exporters helped to cushion the impact of external shocks on export growth. As a result, our growth forecast for 2025 has been revised upward, reaching 1.1%. However, we expect the growth to slow to 0.6% in 2026, reflecting a growing drag from exports. There are increasing signs that underlying inflation is firming toward the Bank of Japan's 2% target, which is leading to expectations of higher risk-free rate in the future. At the same time, on the right chart, we observe significant decompression of term premia on ultra-long JGBs, reflecting reduced demand from domestic institutional investors, higher global term premia in major advanced economies, and the growing uncertainty about the future fiscal policies. Moving on to risks, an important risk is tech cycle, which we see is two-sided. On the downside, the tech cycle, the left chart, the tech cycle has boosted growth in the last few years and continues to be strong. This is mainly supported by AI-driven demand. But if we see the yellow line, which is the stock price of Asia tech, the increase is so fast that it could ease in the near term. This could affect tech investment. In the long run, on the right chart, the tech cycle could be upside risks for Asia. The right chart compares the AI preparedness of Asia with the rest of the world. For all income groups, the Asia-Pacific region is better prepared for AI than other regions. The fast adoption of AI technology could spur new investment and facilitate the productivity growth. Regarding other risks, we note pockets of vulnerabilities in debt. On the left, the debt servicing capacity measured by interest coverage ratio deteriorated somewhat for both AEs and EMs, reflecting higher interest payment obligations following the monetary tightening cycle. Furthermore, debt at the risk, the share of debt in firms with a very low interest coverage ratio also increased among the EMs, with the real estate sector showing the largest increase. On the right, the private sector's external debt is increasing in some emerging economies, although the median has declined. Some of the emerging market economies increased external debt in private sector compared to the pre-pandemic level. Tighter than expected monetary and financial conditions, including currency depreciation, could put more pressure on the corporate's balance sheet conditions. Turn to policies. The macro policies have supported demand and are expected to continue. On the left chart, the soft domestic demand and negative output gaps have contributed to inflation below target in many Asian emerging markets. On the right, many countries have eased monetary policy and are expected to continue to be accommodative until 2026. The red bar is the materialized change by 2025 Q2, and the striped bar is the change until end of 2026. Additional easing may be expected in countries where inflation is below target. Finally, near-term fiscal support should be aligned with sustainability and underpinned by reforms. On the left, the fiscal policies have been eased in many countries. For example, China, Korea, and Indonesia have introduced fiscal packages to support demand and fund priority programs. In some countries, temporary and targeted fiscal measures could support the demand and help vulnerable groups affected by the tariff shocks. On the right, in countries with high public debt, the debt servicing pressures are likely to arise amid softening growth. Public debt surged in many Asian economies during COVID. And soft domestic demand and the possibility of additional trade shocks may trigger renewed fiscal policy support and a further increase in debt. Fiscal reforms, including introducing medium-term fiscal framework and improving the adequacy and the coverage of the social safety net in Asia, will help to anchor fiscal adjustment and improve the effectiveness of fiscal measures. I'll stop here. Thank you so much.
Thank you very much. Please. I like his insightful lecture, and I think this is especially important because I think we can access to IMF institutional view of this world economic outlook. So we have 10 to 15 minutes for floor discussions, and I'm welcome for your question, please. Well, in the meantime, you prepare for your question. I would like small question for Mr. Ando. And I think IMF position is for monetary policy easing is suggested for member countries here in constituency. But in case in Korea, because of the exchange rate pressure, so Bank of Korea is very hard to move on to easing policy because that could raise the imported prices. So for each country, for specifically case in Korea, what might be the suggestion for your sort of suggestions?
Thank you for your question. Regarding Korea's monetary policy, this is really the job of Article 4 consultation, so I won't go into the details. But the general principle is that monetary easing is appropriate if the inflation is below the target, and when it comes to the concern about the FX exchange rate, for instance, FX intervention is one way to control the foreign currency, but it's like flexibility in exchange rate is usually the first line of defense, and if the market is disorder, this FX intervention might be appropriate, but there should be following the IMF's integrated policy framework.
Mr. Yoon, having? Okay. Well, Mr. Yoon, how do you feel about the presentation for Mr. Ando?
Okay, so I see, by the way, it was a really good presentation, and I enjoyed your contents of regional economic outlook from the IMF, and I saw several differences between IMF and our forecast. For example, for the ASEAN countries, our projection is, I think, a little bit higher. Our numbers are higher. On the other hand, for the United States, even if you are not covering the U.S. economy for today's presentation, I see our view is a little bit more conservative than the IMF. So maybe IMF is right and maybe our views are wrong, but I wouldn't say that. But the logic behind why your view for the ASEAN 5 countries are relatively negative than ours, I was curious about what your baseline or assumptions that you have for the ASEAN countries.
Thank you for the question. Regarding this, each country's projection within IMF, there is each country team, so they are really the owner and expert of the projection. There are several possibilities. For instance, the assumption on policies are different. So I wouldn't be able to talk about each country's details, but this thing, we know that is going to be constantly updated as we get the new news. The next update will be January, so we'll continue, right? We'll continue to incorporate new information in the projection.
Thank you very much. Mr. Ando, do you have any idea for Mr. Yoon's presentation, or small question?
Yeah, I think the presentation was very nice and informative, and covers many countries. Probably, I would have one question about what kind of information you usually have in order to make those projections. Some countries are very far from Korea, so could you share a little bit about that?
Actually, how we work is very similar to IMF is working. What I heard from you or other IMF staff members is that you have regional department and experts for that region, and we also have the regional departments such as China team, India team, ASEAN team, and US team, and so on. So we usually receive information and projection numbers from them, and we incorporate those numbers together to put into the World Economic Outlook, and we give them feedback, and we do that process several times. Then finally, we finalize our projections. So I think it's very similar. Actually, I think we learned how you work. So from how you work. So that's how we make our numbers and storytellings and so on. Yeah.
Well, thank you very much. I think this is a sort of a prime platform for sharing the knowledge and discussions with the KIEP and IMF. And I hope you pretty much enjoy these discussions. Well, please make some big applaud for these two speakers, please. Thank you very much.
Okay, thank you, Professor Kang. This concludes session 1. We will now have a short coffee break for about 18 minutes. Session 2 will begin at 3:20 p.m. Thank you. Timed. Welcome back, everyone. We will now begin session 2, Asia's value chain and its implications. This session will be moderated by Professor Jaerim Choi from the Department of Economics at Yonsei University. The session will include 2 presentations followed by a panel discussion. Professor Choi, the floor is yours.
Okay, let's begin session 2 of the 15th KIEP-IMF Joint Conference. Session 2 is titled Asia's Value Chain and Its Implications. So we'll begin with 2 presentations, first by Dr. Chikako Baba from IMF, and then Dr. Namseok Kim from KIEP. So each presenter has 20 to 25 minutes. And after main presentation, we'll have panel discussions. So there will be 4 discussants. So each discussant has 5 to 10 minutes. So after panel discussions, so I will give the 2 presenters to respond to discussions. And after that, we'll begin an open Q&A session. So let's first begin with Dr. Chikako Baba from IMF.
Thank you for the introduction, and thanks a lot for having us here. It's really an honor to present in front of this distinguished guest. So let me just begin that this is a chapter that we prepared for the October publication of the Regional Economic Outlook for Asian Pacific. And this year, for the analytical chapter, we focused on the trade, in particular the regional supply chain and the scope for deeper trade integration in the region. Let's see. Why is this topic important? I mean, it should sound almost obvious to many of you. The short answer really is because the trade is so central to the growth in Asia. The role of trade or exports in driving growth and the structural transformation have been very well documented in the literature. And beyond growth, there is a large body of literature documenting, the additional benefits from the trade, including the infrastructure developments, job creation, and the poverty reduction. However, as all of us are aware, the landscape has been changing. The change in the trade and trade policy can seriously hurt the region's growth as its engine, the trade, is being affected by these policy changes. So against this backdrop, the overarching question that we ask in this chapter is how can Asia-Pacific economies maintain trade as an engine of growth? And in particular, we focus on 2 aspects. One is that what are the lessons that we learned from the previous episode of trade tensions so that we can learn in the current context. And the second is how large the benefit would be if countries in the region pursue more trade integration. So let me start with presenting some of the key patterns and trends of the trade in the region. So I start with something very simple. So the left chart shows the trade openness measured by the share of exports in the global exports. Then it's you see the Asia Pacific as the big red dot towards the upper right to the chart. So it basically indicates that the region accounts for about a third of the global trade, and which is about the same as the region's share of region's economic weight in the global economy. However, inside the region, openness is fairly heterogeneous. ASEAN economies in particular stand out for their openness, with their trade far exceed the GDP as a share of the global economy. And in contrast, the South Asia remains relatively less open. Looking at the structure of the trade in the region, one thing that we want to highlight is the significance or importance of China and the US. So in the left, we show the countries, the region's largest import and export counterparts. So for 16 economies in the region, China is the largest import source. These 16 economies represent about 99% of regional GDP if we exclude China. And what these countries import from China, well, 2/3 of the imports from China to the region are intermediate goods. On the export side, the US, which is indicated by the green part in the left chart bar, the US is the largest export market for the 10 economies in the region, and the region mainly export the final goods. So the region has the supply chains such that the China plays the central role as a hub of production to serve the final goods to the overseas market, primarily the US. And given this structure, the trade tensions that intensified between the US and China from let's say 2016 and onward, that escalated to the tariffs in 2018 have particularly relevant in shaping or reshaping the trade patterns in the region. And in fact, when we were looking at the trade data, one noticeable development in the region in the last decade is the sharp rise in the inter-regional trade, especially in the intermediate goods. That started in around 2017. If you look at the left chart, the red line shows that the inter-regional trade represent a much higher share of the trade that the Asian Pacific economies have. And there is a jump around 2016-17. And what is interesting is the fact that this rise in the degree of inter-regional integration is driven pretty much solely by the region's trade with China. In fact, the green line in the left chart shows that the inter-regional intermediate trade among the Asia-Pacific economies remain pretty flat if we exclude China. And in addition, on the right-hand side chart, we show what China is exporting. In the right-hand side chart, we show that the counterpart of the China's exports for the intermediate goods and the final goods. And you see that the rise in the Chinese export to the region is observed only in the intermediate goods and not in the final goods. So there is a deepening inter-regional trade after 2017, but it is not the generalized rise that the countries in the region somehow start to trade each other. But it's more like somehow China start to increased their export to the region of the intermediate goods, starting around 2017-ish. Given the timing, this lead us to the conjecture that these data are indicative of the supply chain reconfiguration as a result of the previous round of the US-China trade tensions. It's kind of natural to assume that some of the production of the products that are targeted by US tariff move to other countries to the region from China, but they still use some intermediate goods from China to produce. So that's kind of the conjecture we had related to the pattern of the trade in the region. And that's what we kind of try to test in the empirical model. So we kind of we dive deeper into how trade and supply chain have responded to tariff shocks. Today, I don't go into the detail of this econometric specification, but I just want to highlight two things that is unique in our specification. One is that in studying the Trump 1.0 tariff impact in the region, we focus on the so-called value-added trade because the gross exports among the economies may reflect multiple factors, including like the transshipment, which is not necessarily related to the domestic value added. So to strip out this impact, we focus on the country's domestic value added that is embedded in their export to the US. And in our empirical specification, well, technically it's called a difference in difference specification. We measure the relative growth of domestic value added embedded in their export to the US in tariff targeted sector relative to non-tariff targeted sector. And we use the data from the Asia Development Bank's input-output table starting from 2008. And it covers 23 countries from the region. So these two charts are the main result of our empirical model. So the left chart plots the estimated impact for each country of the tariff shocks in 2018. So it indicates that the tariff targeted sectors in some countries in the region have experienced faster growth in value-added export to the US in tariff-targeted sector compared to the exports from unaffected sectors. The countries that experience this higher relative growth in tariff-targeted sectors are Cambodia, Bangladesh, Vietnam, Sri Lanka. And in the right chart, we show that these countries that experience higher value-added export to the US, they also experienced increase in the intermediate imports from China in the tariff-targeted sector. These patterns really point to the supply chain reconfiguration to so-called China plus one. Before moving on to the next slide, let me also mention the observation that our estimated impacts are fairly heterogeneous across countries. As in the left chart, you see that many countries have the estimated impact being negative. There are a few possible reasons for the negative impacts and also the heterogeneous impacts across countries. So most obviously, the negative impact can mean that the countries didn't succeed in capturing the slack that they created by China that faced the US tariff. This can be magnified if production by countries gaining the market share, like Vietnam, crowd out the other countries by leveraging the scale economy. But the negative impact can also reflect some structural relocation of production by multinational enterprises. Like some of the firms from Korea or Japan started to move their production out of the country to the rest of the region. And we try to capture that by including some of the autocorrelation terms. But to the extent the tariff shocks accelerate these relocation decisions, our control may not be sufficiently capturing that impact, and that can contribute to the negative impact. And also, because our estimate is the relative performance of tariff-targeted sector versus the non-tariff targeted sectors, and non-tariff targeted sector include the service sector in particular. And so countries with rapid growth in service, most notably Philippines, India, but also advanced economies like Korea, Japan, tend to have lower estimate of the relative gains. Having said that, still, the countries that benefited most from the supply chain reconfiguration seems to have experienced the partial relocation of production from China. So the left chart plots the country's relative gains in export to the US that I showed in the previous chart against their gains in FDI inflows from China. The chart shows that the countries that successfully exploited the opportunity to expand export to the US, meaning Bangladesh and Vietnam, also experienced more FDI from China. So these countries most likely received the FDI and they could expand their capacity to export to the US. Now, the question is why there are some countries that were more successful than others. To see this, we regress the relative gains, our estimates, on several key characteristics of the economies. The right chart shows the regression results. So it seems that the larger gains were observed in economies with favorable preconditions. These include lower unit labor cost, high openness to FDI, pre-existing trade linkages with both China and the US, as well as political stability and geopolitical alignment with China. So all of these factors are the ones important for the firms to decide their relocation of FDI. Overall, what we learned from the US-China 2018-19 tariff episode is that the supply chains are indeed responsive to the tariff differentials. However, in the current trade policy environment, the same type of supply chain reconfiguration can be more challenging. This is because unlike the last time that China is the main target of the tariffs, this time around, many countries face different tariff rates. And there is the discussion to strengthen the application of the rules of origin. And at the same time, the Asia-Pacific region has become more reliant on the external demand from outside of the region. That's what this chart on the right shows. So in the current context, countries that substantially use the foreign inputs for downstream production will need to expand their domestic production, leverage more FDI, and diversify their import sources to better navigate the environment. Now, a natural question to ask here is, given the difficult situation, is there a scope for deeper regional integration to further strengthen the region's resilience? And that's our next question. So, just as a background, the Asia-Pacific region is quite well integrated if we focus on the intermediate goods trade. As you can see from the left chart, the inter-regional intermediate exports represent about 55% of total intermediate goods exports. That level is, well, about comparable to what we observe in other regional blocs like the EU or North America. But picture is really different when we look at the final goods. For final goods, inter-regional exports in Asia represent only about 30%. And it's apparently much lower than the level we observe in EU or the North America. Of course, this low share of regional trade in final goods reflect the prevalence of regional supply chain that ultimately serves the final goods export to the overseas market that I touched on at the beginning. And reducing this gap for final goods will require stronger final demand from the region, and that needs to be supported by structural reforms, as the conjuncture chapter in the previous presentation argues. At the same time, given this gap in the final goods trade integration, it also highlights that there is untapped potential for deeper intra-Asia integration in trade. So how can countries achieve such, can deepen the trade integration? Here, we also want to highlight high non-tariff barriers in the region. Right chart shows that the non-tariff barriers are especially prevalent in South Asia and parts of ASEAN. Non-tariff barriers can affect both intermediate and final goods trade, while some instruments such as standards and technical regulations may be more relevant for final goods trade. And hence, non-tariff barriers can be a factor holding back final goods trade in the region. What might cause these high non-tariff barriers in the region? Economic literature underscores the importance of the trade agreements in promoting trade growth. And in fact, our examination reveals some areas for improvement when it comes to the trade agreements in the region. So left chart shows that in Asia, most trade agreements are bilateral, either between two countries or a country with a regional trade bloc such as ASEAN. And this pattern is a little different from Europe or North America, where integration is supported by broad-based, legally binding agreement involving large economies. In Asia, countries rely on bilateral deals that may have created a patchwork of overlapping rules, inconsistent standards, and the lack of institutional coherence. Second thing that I want to point out is the depth and the legal enforceability of trade agreements. The right chart shows the distribution of trade agreements in depth across country pairs. By depth, what I mean is the extent of the legally enforceable provisions. Compared to Europe and North America, the depth of the trade agreements in Asia tend to be lower. And as you see, South Asia has particularly shallow coverage of the provisions. With this, we explore how large the potential gains are from strengthening the trade integration in the region. And our approach builds on the literature. So the reduction in non-tariff barrier, we assume, is reflected in an increase in the number of legally enforceable provisions in trade agreements. To give some intuition of what we do, well, we are assuming like this. Think of provisions such as policies related to technical barriers, trade, public procurement, or trade-related investments. Favorable setting for these policies could boost trade independent of tariffs. And this is what the empirical evidence in the literature finds. So we use a measure of Depts, trade agreement Depts, based on the number of legally enforceable provisions between the two countries, and use it as a proxy for the non-tariff barriers. And then we hypothetically increase the depth of the trade agreement and take it as a reduction in the non-tariff barriers. So first, let's consider a scenario where Asia-Pacific economies integrate among each others from the current relatively shallow framework to the maximum level of the depth. The chart illustrates the long-term gains. And as you can see, they're quite sizable, averaging about 1.8% of GDP for the whole region. The intensity and the channels to achieve such gains are different across countries. Most obviously, countries gain more if their starting point is very low, meaning that countries have shallow trade agreement, have much bigger room to gain. This is an important driver for South Asia. And also, some of the regional partners have scope to gain from the deepening trade agreement with South Asia. Beyond the starting point, there are a few other mechanisms explaining some countries gain more from the trade integration. The left-hand side chart shows that the smaller economies gain more than larger economies because they benefit from gaining access to bigger markets and cheaper access to final and intermediate goods. Also, the right chart shows that the benefit is higher for economies that are deeply integrated in value chains, as gains from cheaper intermediate goods cascade through every production steps and multiply. Finally, we also highlight that the gains would be larger if the Asian economies reduce trade barriers against economies outside of the region, that is represented in the red line. Now, before concluding, let me add a caveat of our analysis. So what we presented here are aggregate gains from trade. But past experience have shown that within a country, there are winners and losers from trade. And for them, targeted support may be needed for adversely affected sectors and workers so that the distributional impacts of trade liberalization be mitigated. So let me just quickly wrap up. So we document that the tariff shocks promote some supply chain reconfiguration along the pre-existing value chain networks to countries with favorable preconditions. And we also show that the lowering non-tariff trade barriers could deliver sizable long-term gains. And as for the policy recommendations, we highlight the importance of greater openness in trade and FDI, which should be supported by policies to enhance the economy's competitiveness and macroeconomic stability. so that it can support resilience in a more fragmented global environment. Let me stop here. Thank you.
Okay. Thank you, Dr. Baba, for your presentation. Dr. Baba summarizes the role of Asia-Pacific value chain and its resilience amid the trade war, and also pointing out the role of China's FTA into this region. And also she provides some suggestions for deeper economic integration in this area, including final goods integration and eliminating non-tariff barriers. Okay, so now we'll move on to second presentation. Dr. Nam-seok Kim from KIEP will provide his presentation.
Thank you very much. My name is Nam-seok Kim, and I'm currently the head of the Southeast Asia and Oceania team in KIEP. And I'm very happy to present Korea's outward FDI amid supply chain fragmentation in Asia. So this year, our research team at KIEP has investigated how Korean firms should respond to rising uncertainties in international trade. Over the past several decades, Korean firms have been highly proactive in establishing global production networks. In the current environment, where geopolitical factors and strategic competition are prompting a reconfiguration of these networks, it is essential to rigorously assess how Korea's outward FDI has affected key firm-level outcomes such as domestic employment and sales performance. So over the course, so actually my presentation consists of two parts. So before I actually address the empirical estimation that we did, please let me first briefly introduce some motivational backgrounds about the supply chain fragmentation in Asia. So over the course of the first Trump administration, the Biden administration, and now the second Trump administration, strategic competition between the United States and China has deepened in both scope and intensity. In the wake of the COVID-19 pandemic and a series of wars, countries have become acutely aware of the serious problems caused by supply chain instability, and the notion of economic security has emerged as a core agenda in both domestic and foreign policy. So earlier this year, the announcement of the reciprocal tariff and the move into a negotiation phase over a potential trade deal pushed uncertainty to a new peak. Amid this development, the concept of reshoring and nearshoring have begun to gain prominence, and a growing body of empirical evidence is consistent with this new trend. So from 2021 to 2023, global FDI flows declined, but in contrast, FDI inflows towards Southeast Asia continued to increase over the same period. So at the center of this trend was the expansion of investment towards ASEAN member countries from the United States and China. Over this period, United States firms' investment in ASEAN doubled, accounting for roughly 1/3 of total FDI into the region. And Chinese investment also surged, particularly in manufacturing, further strengthening China's presence in ASEAN's manufacturing sector. So as some parts of Asia were benefiting from the reshoring and nearshoring movement, the global environment shifted into a phase of reciprocal tariff. Because countries differ in their patterns of industrial specialization, policy frameworks, and the size of their trade surplus vis-a-vis the United States, their responses to this reciprocal tariff has varied significantly. So this table shown here is a response matrix for ASEAN member states that our team compiled earlier this spring, and it highlights how diverse these policy reactions have been even within ASEAN. So how will such diverse policy reactions ultimately aggregate into a broader pattern of supply chain fragmentation, and what implications does this hold for South Korean economy? So to address these questions, so our research team in KIEP has carried out a series of studies over the past 3 years. And one of these projects conducted by one of my colleagues uses input-output linkages to quantify at the industry level the change in GDP that would result from a sudden shutdown of intermediate imports from China. The study then compares this with a scenario in which those Chinese intermediate imports are fully replaced by imports from other exporting countries. This table presents a recent scenario analysis for Korea's chemical product sector. The first column shows the change in GDP for the chemical industry when all intermediate imports from China are cut off and not replaced at all by imports from any other country. The second column shows the corresponding change when all of those Chinese imports are instead fully substituted by imports from existing supplier countries. The first two columns report the impact on GDP in the chemical sector itself, while the two columns on the right show the resulting change in aggregate GDP once these shocks are propagated to the rest of the economy through these inter-industry linkages. So because countries differ in their degree of dependence on China and in their industrial structure, the resulting welfare effects naturally vary across countries. So what is particularly interesting here is that if intermediate imports from China are cut off and not replaced, then all ASEAN economies experience a decline in GDP. However, if those imports are fully substituted by imports from other existing supplier nations, then all Asian economies except China see an increase in GDP. Yeah, so please let me skip the table for the electrical products. So actually, the qualitative same insight can be applied to the consecutive table earlier. So in practice, the key actors that implement this reconfiguration of supply chain are firms that invest abroad and reorganize their production networks. So for Korea, this naturally leads to the following question. When Korean firms undertake outward FDI to adjust their supply chains, does this undermine domestic jobs and sales? Or can it support domestic performance instead? The second part of my presentation tries to answer this question using firm-level data from Korea. So I will show that Korean firms' outward FDI is, if anything, associated with higher domestic regular employment and stronger sales performance rather than a hollowing out of the domestic economy. So in particular, Korean firms have recently undertaken large-scale manufacturing investment especially in Southeast Asia and India, and investment towards the United States is also expected to surge following a possible, which is already made a trade deal between the United States and South Korea. So as a result, there is growing concern in Korea about the hollowing out of domestic industry. So to rigorously assess these effects, we incorporate rich firm-level characteristics into our empirical framework. So, we use firm-level data announced by the Statistical Bureau of South Korea. So it is annual enterprise survey which provides both cross-sectional and panel longitudinal data. And the name of the data set is Survey of Business Activities. So this study uses panel data coming from this survey, starting from 2006 and 2023. So the Statistical Bureau provides a companion data set which elaborates the outward FDI cases of firms surveyed in the Survey of Business Activities, and it elaborates the destination country of each investment case and the nominal magnitude of investment in Korean currencies. So because the panel IDs in this companion data set can be matched, so we were able to match the FDI information with the main body of the survey. So I brought some figures as a descriptive statistics. So please let me skip first two figures. So the main message that I wanted to share is that actually this survey is very representative, and the distribution in terms of year and in terms of industry is very similar to the distribution in the population. And the interesting figure is the third figure that I brought in the slide. So actually, this is the number of Korean firms with outward FDI expenditure by top 5 destination for Korean firms. And we can see that the China is the most famous destination, and the United States is the second, and the Vietnam is the third. And the number of firms engaging in FDI to China has been stagnating. But in contrast, number of firms investing in the United States and Vietnam has risen sharply in recent years. And the number of firms investing in Japan has been growing gradually, but the number of firms that are investing towards Hong Kong has been declining. And this is also the summary statistics for the number of investing firms for the key manufacturing sector of South Korea, and also average number of destination countries per firm, and average investment amount per destination country, and the share of China among their aggregated investment. And the key insights that you can get here is that, so across all major manufacturing industries, the number of foreign investment destination per firm did not exceed 1.5 countries. And the firm level average investment amount per destination varies substantially across industries. And for sure, China is the largest destination for Korea's outward FTA for Korea's key manufacturing sectors. And this is kind of like comparative summary statistics between the firms with outward FDI history and those without outward FDI activities. And the numbers are coming from the average of 2022. And the key insights that you can get here are pretty intuitive. So firms with FDI history are larger in terms of employment than non-OFDI firms. And OFDI firms have more assets compared to non-OFDI firms. And also, OFDI firms are older compared to the non-OFDI firms. So even though these summary statistics are pretty insightful, but it was not enough to derive some kind of causal relationship between the FDI activities and the firm performance. So we therefore adopt instrumental variable estimation to handle some causal relationships. So using the firm level survey that I introduced earlier, we construct an annual panel data set covering the period from 2006 to 2022. And our 3 main dependent variables are domestic regular labor, regular employment, which I indicated as lab, ICT. So subscript I stands for firms, and C stands for industry, and T stands for year. And the second key dependent variable is export performance, like export ICT. And the third key dependent variable is revenue, the sales revenue performance indicated as Rev ICT. And the key explanatory variable is the cumulative magnitude of investment within the survey, which I indicated as C INV, ICT. But here, a serious endogeneity problem can arise because these firm level outcomes can in turn significantly influence the firm's decision to invest in foreign country. So to address this issue, we follow Desai et al. And implement an instrumental variable strategy. To be specific, we use a weighted average of GDP growth rates in the firm's FDI destination countries as our instrument. And by construction, because these instrumental variables can be defined only for the firms who actually made an FDI expenditure, this estimation research should be considered as some kind of research for intensive margin rather than extensive margin. So because our CINV, which stands for the cumulative investment amount, only reflects the aggregated amount within the survey, there can be some missing information for the investment activities earlier 2006, which is the starting point of our survey data. So we had to add some control variables such as age of the firm, both for linear term and non-linear term, following the industrial organization literature, and also R&D expenditure and the asset level of each firm. And we are implementing the firm level fixed effects. So please let me share the estimation research. So I gradually added the control variables starting from age, both linear term and non-linear term of age, and asset and R&D expenditure. And each 3 columns for each panel stand for the results for labor, the domestic labor employment, and export performance, and the revenue magnitude. And we can see that for all 9 columns, we can identify that there is no significant relationship between the cumulative FDI investment and the export performance. But however, for the domestic labor employment and revenue performance, we can see that more cumulative FDI expenditure were correlated to the larger domestic labor employment and the larger revenue magnitude. And these results were pretty robust, regardless of the configuration of the control variables. So please let me interpret this result in a qualitative way. So our results show that firms with larger accumulated outward FDI tend to increase their domestic regular employment and sales. So this indicates that the commonly held argument linking outward FDI to a reduction in domestic regular employment lacks empirical support. And in addition, firm sales performance also improves as their overseas production networks expand, which is measured by outward FDI expenditure. But however, outward FDI does not explain the export performance itself. And for the relationship with other control variables, employment, exports, and sales increase as firms grow older in their earlier years, but the magnitude of this increase diminishes as firms further mature. And firm level asset size and R&D expenditure do not provide additional explanatory power beyond what is already captured by outward FDI, firm age, and fixed effects. So please let me conclude with some kind of implications for Korean international economic policy. So as we discussed in earlier part of this presentation, supply chain fragmentation will create substantial uncertainty for Asian economies. And amid these uncertainties, for a highly trade-dependent economy such as South Korea, outward FDI has been a core driver of export-led growth through global production networks. And based on this, some background knowledge, we have to emphasize that our empirical research showed that outward FDI increases domestic regular employment and improves sales revenues. And at least on average, like concerns about industrial hollowing out, especially amid new Korea-US bilateral trade deal, are not supported by the evidence that we share in this slide. But for sure, there can be some big source of heterogeneity. So if we conduct some kind of like subsample analysis for specific industry or specific regions, the results can be qualitatively different. So I should note that these results can only be understood as a like on average effect, including our industries and our regions in South Korean economy, between the cumulative outward investment and the firm performance, such as domestic employment and revenue performance. So at least based on this like average effect between FDI and firm performance, Korea can adopt a proactive reallocation strategy through outward FDI to strengthen resilience rather than retreat from global networks. So such a strategy will enable Korea to secure strategic production footholds abroad while maintaining high-value activities and job creation at home. So yeah, this concludes my presentation. Yeah, thank you very much.
Thank you very much, Dr. Kim, for your insightful presentation. So Dr. Kim pointed out a new pattern after the first protectionism, especially in the first Trump administration, such that FDI into the ASEAN surged, and then both US and China contributed to this pattern. And secondly, he actually tested an interesting effect, which is a hollowing out effect, whether outer FDI crowd out domestic manufacturing. And then interestingly, he found no such effect existed in Korea. Okay, so now let's move on to panel discussion session. So we have 4 discussants, and all 4 discussants should stay here and then discuss the presentation. So the order is the first discussant will be Dr. Chikako Baba, and second Dr. Ju Young-jung, and third Jung-wan Choi, and the lastly Dong-hyun Park. Okay, so Dr. Baba, please go ahead and discuss the presentation.
Thank you. Okay, so let me start off by saying that this is an important and interesting analysis. And the impact of globalization on domestic economy has been a center of discussion in recent years, and your analysis is really to the point of the interest of the policymakers. So let me just start off by summarizing 3 key findings of the paper. So first, maybe obvious is the fact that the FDI and hence supply chains in the region have been shifting with the rise of geoeconomic tensions. And second, the Korean multinational enterprises, well, they are the important players in the regional and global supply chains, have been steadily increasing their direct investment overseas, especially in China, US, and Vietnam. And thirdly, these rises in outward FDI are complementing the growth of the Korean economy by raising employment and sales revenue. That's what empirical analysis finds. And overall, these findings are in line with the economic literature for other economies, in particular for the US, and hence I think these are fairly reasonable results. So with that, my comments are on how this can be extended to be more interesting and relevant for the policy discussion. So my first comment is to make use of the rich data more fully. I find your from level data of FDI is fairly interesting and actually very hard to obtain for many economies. Because you have very rich data, I think you should really leverage what you can squeeze out of it. It's not clear from the presentation to what extent the data provide the detail, but I think there are a few things that are obvious to explore. One important thing is the intensive margin of FDI at the firm level if sales by the affiliate overseas are available. Because the extensive margin or the creation of the new affiliate overseas takes years to materialize, while the firms have more flexibility adjusting their volume of the sales. So if you find more evidence of the impact of the policy changes in recent period, then that should be more visible in the intensive margins. So I would be very much interested in what you find in the intensive margin. And also, you show interesting trend in the FDI to the US and the China, Vietnam. But apparently, the FDI to these economies seem to serve different purposes, right? So for US, it's probably to sell more final goods to the consumers, while for Vietnam, it is to produce or move some of the production process to further export to the rest of the world. So by just characterizing how these FDI destinations differ maybe by sector or the type of goods they sell, like the intermediate or final goods, would be important and interesting, guiding you or teaching you what aspects that you want to explore in the further empirical analysis. Because your project, based on the title, is focusing on supply chain fragmentation, some highlights from the stylized facts on the fragmentation patterns I think are useful. From what I can see, the patterns of the economic fragmentation is a little less obvious because the FDI from Korea has been relatively monotonically rising. So what you see as the impact of the fragmentation in the FDI data is one thing that I'm really curious to see. Now, with the micro data, I think there are multiple directions to expand your empirical analysis. In the background, you may have tried some of them. I would very much like to see how the results differ between manufacturing and other sectors. The FDI data that you showed in the slide suggests that FDI is rising, most notably in wholesale and distribution sector, while the FDI for production is, the growth is more flat. So, but the FDI for production and sales have different implications for the home country. So I would separate these things if you haven't done that. In a similar vein, differentiation such as upstreamness of the industry, value chain participation of firms, horizontal or vertical FDI integration, differentiation by export destination country. I mean, all of these things can offer more nuances to your findings. And I wonder if this type of differentiation help explain what the non-findings of the statistically significant result for exports, because exports of final goods, for example, to the US or higher wage countries may indeed increase the domestic production and enhance the exports from Korea, but the exports of intermediate goods to Vietnam simply shift some production steps to the Vietnam and may not be positive for the export from Korea. So some of the differentiation may kind of clarify these patterns more clearly. In terms of the variables of interest, I think the study covers very obvious ones like employment, export, sales. I think it's also interesting to highlight some distributional impacts to substantiate the point that you make at the end, that the high-value activities remain in the country, which is, by the way, a very important point if that is, can be shown to be the case. This extension is conditional on the data availability, but if there is any differentiation by employment by skill level, then that would be very interesting to investigate how the FDI affected the labor or employment in different skill level. And the reason why this extension is interesting is, of course, ultimately, these analysis can address the fundamental questions on the distributional impacts of offshoring. And so that is very relevant for the policy discussion. My final comment is fairly technical, minor one, so that I would suggest that revisiting empirical specification, possibly to use variables in log or growth rate, so that you can facilitate the interpretation of coefficient, because in that way you can interpret its elasticity more straightforwardly, and also it can alleviate some of the non-stationary concerns. So with that, let me conclude that by congratulating you on this important work And your finding basically suggests that the geo-economic fragmentation can be costly because it kind of reverse what the benefit that the Korean economies are achieved from expanding the FDI, and hence the message is very consistent with our findings that the greater openness is key to navigating the current environment.
Thank you, Dr. Baba, for your very constructive comments. So now let's move on. The second discussant, Professor Chu Young-jung from Kyunghee University.
Thank you for giving me an opportunity to discuss this very interesting and an important studies. I'll discuss the paper one by one. The first paper by Dr. Baba. Let me give a brief summary of this paper because I'm the first one who actually discussed this paper. This study finds that U.S.-China in the 2019 trade tension reconfigure supply chain in the Asian Pacific regions, but the effects are heterogeneous across countries depending on the country characteristics. And given that we are going to have uncertainty, higher uncertainty in the future, and with more stricter application of the rules of origin, the Dr. Baba's study also suggests a deeper economic integration within the Asian Pacific region, especially by reducing non-tariff barriers to boost up the final good trade. I think this is a really important observation, and then she also provided very valid policy suggestions, especially to cope with the emerging challenges we are going to face in the future. But I also like to suggest a few more things to look at the changes in supply chain in the Asian Pacific regions for more comprehensive perspective, I think. As this study initiates its purpose of from this aspect, I think it has more room to investigate if the gains from value-added exports found in this paper for some countries, especially Vietnam, Cambodia, and Bangladesh, will be staying as a longer-run effect and then eventually lead to economic growth, rather than just remaining as gains of export in for temporarily period. Also, I think it can expand the source of export gains by comprehending the destination countries it analyzes. Currently, your study is limited to the value-added exported to the U.S. only. So due to the U.S.-China trade tension in 2018, not only the countries changes their volume to export to the U.S., but also they change the destinations of the exporting country, as you have already shown for the Chinese case, right? So if we comprehend all these things, it may alter finding of this study in regards to who are the beneficiaries and who are the losers, I think. Then lastly, I also think they may consider geographical factor as an important factor correlated with the relative gains in the export, value-added export, as you have shown that already. According to your study, we see that the correlation with the Asia-Pacific interaction term of the Asia-Pacific and labor cost shows the higher correlation rather than the only labor cost, right? We also have a recent empirical study which shows that the distance trade elasticity for final good trade is larger than intermediate goods trade. elasticities. So since the US-China trade war, beneficiary countries such as Vietnam and Bangladesh, Cambodia, as we may know, that in many cases used as a platform to export the final good to the US to evade the high tariffs imposed by the US. So I think the country which are geographically closer to China have enjoyed greater gains if all other things being equal. So I think this is also considered as one of factors to figure out which one is the beneficiary or losers. Importantly, this paper suggests that deeper regional integration to handle the emerging challenges we are going to have in the future. So as a supportive stylized fact, this study suggests the chart, as you can see in this slide. So this graph actually shows that in Asian Pacific regions, the final good intra-regional trade share is lower compared to other regional blocks in Europe or North American regions. And then this suggests the objective of reducing non-tariff barriers with the deeper integration within the region is to boost up the final goods trade. However, I believe that we need more carefully approach this objective. The reason is that observing the fact that observing this kind of the fact may result from other reasons besides that. For example, the degree of heterogeneity within the regional block actually generated a different degree of the comparative advantage in a different production stage of the goods each country produces, right? So, furthermore, we also need to think about the opportunity cost of the producing intermediate goods and then final goods. What I mean is, so rather than just to boost up the final goods, we have to think about which production stage actually bring us the greater value added, upstream intermediate inputs or downstream final goods. So according to the recent studies, the effects could be heterogeneous across the production stages. So these two diagrams is from the Meng, Ye, and Wei in 2020 papers. In the first chart, the left-hand side chart is China's ICT 2009 SMILE curve for value-added gains in export-related GVC, and the right-hand side is the US ICT SMILE curve in 2009. As you can see here, the two graphs shows a different shape, and even though they look at the same industries in the same year. So this is, I think, one more thing we can consider. The second paper presented by Dr. Kim, I only focused on the second part of Dr. Kim's study, given that Dr. Baba already gave a very detailed discussion on his paper. So Dr. Kim's paper looked at how the Koreans' outward foreign direct investment affect the Korean firms' performance, and then he finds that local employment and the revenue increases with outward foreign direct investment of firms, but the firm's export performance is not affected. And then also emphasize that the expanding overseas production network of firms is associated with the improved firm's sales performance. So I'd like to add a couple of comments besides Dr. Baba's. given that in Korea we have a group of firms so-called Jebel, which have a large number of subsidiaries and affiliated firms. But by the setting of the estimation equations, it can only look at the firm's own performance and then employment level. So I think it'll be interesting to look at how the affiliated firms and subsidiaries effects and the performance are affected by the headquarters outward foreign direct investment. And then given that you also have the information on the destination country of the foreign direct investment, the firms going out, it'll be interesting to look at how the destination-specific effects are heterogeneous, especially for the labor employment effect. So we have different kinds of the workers, or the production and the non-production workers, how depending on the destination level of the income or the purpose of the foreign direct investment, you can see that how the employment of the different kind of the workers have different effects. Okay. And then this is a pure question from mine, and it also says, I think I pointed out in the earlier slide, and then it says, if a firm expands the overseas production network, then it increases the sales performance, but in the estimation equations, I don't, probably from my ability of the limitation of the understanding, and I can't really see that how you measure the expansion of overseas production network, and how you can observe the expansion of the sales performance as well. Okay, and then it'll be also nice to provide some mechanism why we do have different effects across different dependent variables. On top of that, it'll be I'm actually curious in the slides. In order to initiate your study, you said this study is to understand the firm's strategic adaptation through the outward foreign direct investment. In that case, the outward foreign direct investment should be the dependent variable, and which factors should be which factors should affect, the strategic behavior of firms' decision on foreign direct investment. But foreign direct investment is actually a independent variable. So I'm wondering what kind of effect to represent the strategic adaptation in your study. This will be the last slide I have. And then this is already mentioned by Dr. Baba, I think, but I also want to mention one more time, because we try to see that the reconfiguration of the supply chain in Asian Pacific regions affect, the firm's behavior. So, and then naturally we can think of, U.S.-China trade tension in 2018 is the economic shock we can think of. And as you already presented in the paper, and then the paper I have found from the KIEP, and there is a huge decline in the foreign direct investment to China from Korean firms since 2018 in terms of the accumulation of the stock of FDI. So is there any structural break due to switching the destination from China to Vietnam in 2018, especially when you said, there are, and most of the industries, the top destination is China in our, the Korean firms outward foreign direct investment. Okay. Thank you very much.
All right. Thank you, Professor Jung, for your very detailed questions. Most of them actually overlaps with mine, so I would love to listen to presenters' responses, but we have two more discussants. The next discussant is Jungwan Choi from KIET.
Okay, thank you. My name is Jungwan Choi from KIEP, and it's a great honor to have a chance to two papers from IMF and KIEP. So first, on IMF's works researching value chains, the case for deeper Asia-Pacific trade integration by Dr. Baba et al. So let's summarize. The Baba et al. Studies how the trade structure of Asia-Pacific regions have changed since the first Trump administration, and the author applied different style regressions with having trade war targeted dummy sectors as treated group and evaluate the impact on value-added exports to the United States. And the author found some heterogeneity of gains by countries, like lower for Korea, Japan, and India, and greater positive impact from some developing countries like Vietnam, Bangladesh, and Singapore. And the author also found that countries with value-added gains also experienced increase in imports of intermediate goods from China, and also value-added gains are positively correlated with increase in FDIs from China. And also, to my understanding, in the second part, the author studied to what extent could deeper integration offer resilience. And based on my understanding, the author focused on the impact of lowering non-tariff barriers, and so they implemented scenario analysis, and they found that gains from intra-regional trade are some higher returns to unilateral reductions, and also beyond gains from intra-regional integration, we can expect some long-term additional gains from opening to other regions. So first, I would like to provide some comments on the first part and the second part. And first, I believe that the current work provides some very clear evidence of supply chain or value chain reorganization, mostly driven by increasing intermediate goods imported from China to Asian countries. And also, the gains were very positively correlated with the increase in FDIs from China. So, as all we are very aware of, there exists several anecdotal evidence that multinational enterprises from advanced countries like the United States, Korea, and Japan have switched their production facilities from China to ASEAN since the first US-China trade war. But I was wondering if the author can also find some evidence from the so-called escape from China, from Chinese multinationals in the China mainland. So if the author could provide some evidence on this, and so separate the observations between advanced countries and Chinese multinational firms, it would be very interesting, I think. And also, second, regarding the increase in intermediate good imports from China, I was wondering if the increase in FDIs from China serve as a channel. That is, so the author found that the gains from trade were positively correlated with the increase in the intermediate goods imports were positively correlated with the increase in FDIs from China. But as the FDIs from China increases, I was wondering if such increase in FDI has served as a channel from the increase in intermediate goods from China. And my last comment is that on gains from value-added exports to China, I was wondering if the author could disentangle the value-added exports to forward participation and backward participation. As the author uses to my knowledge, uses the ADB MLO database, I believe the author could disentangle the value-added exports to these two components, and I believe such disentangle would provide some new policy implications. On the second part, honestly speaking, I have limited knowledge on the non-trade barriers, so I would just like to make some comments from the Korea's perspective on the non-tariff barriers. So for Korea's perspective, currently RCEP has played a major role in economic integration with the Southeast Asian countries. However, as you already know, relatively weak level of trade liberalization has been criticized. Therefore, thus the need for access to so-called CPTPP has been rising. However, on joining CPTPP, there exists several challenging issues, especially focus on non-tariff barriers. That is, for example, like reforming sanitary and phytosanitary SPS measures. And they are sparking backlash from stakeholders, especially in agricultural sectors. So for trade policy, so this becomes a hard issue in the trade policy in Korea. So I would like to just remind you this issue on the non-tariff barrier issue. So okay, they were comments on the IMF's work and about Korea's outward FDI amid supply chain fragmentation in Asia, presented by Dr. Namseok Kim at KIEP. So to summarize, as Dr. Baba and Professor Chung have provided very productive comments, I would just briefly summarize Dr. Kim's work. So Kim studied how Korean multinational enterprises FDI affected the firm performances, and the author used survey of business activities provided by Statistics Korea, which is a representative firm level data of Korea, and also applied some reduced form regression models with instrument variables to address endogenous issues. And as you already know, the author found that Korea firms' FDIs have raised employment in home and revenues, but found little impact from the exports. So my comments are very similar with Dr. Chung and Dr. Baba's comments. So I believe this is a very widely studied topic, but however, to my knowledge, there exists little consensus. So I believe that Dr. Kim's work would help us to have deepen our understanding of the issue. So the first one is that at the current stage, Dr. Kim uses instrumental variables to address the endogenous issues. However, we can also understand the Korean MNEs starting business activities as a kind of treatment. So applying causal inference to models like difference in different after propensity score matching, I was wondering if the author might study whether the Korean MNEs starting business activities abroad and becoming multinational enterprises would alter employment or business performances in home. Also, my second comment is very close to the Dr. Chung and Dr. Baba's comments, but the author can also study more detailed analysis by focusing on some heterogeneity stuff, like either by focusing on the size or by focusing on the productivity. Also, as survey of business activities have variables on some detailed information on employee level, like gender or tasks like female or male, or tasks like blue collar or white collar. So I believe that the author might study how the Korea firms' FDI activities affect the employment at the more detailed level by focusing on the characteristics of employees. My last comments, as mentioned by Dr. Chung and Dr. Baba, I believe that if the author can study the impact by purposes of outward FDIs, that is so-called vertical FDI or vertical FDI and horizontal FDI, or so-called market access FDI versus cost-saving FDI, it would be more interesting and deepen our understanding. And one additional my comment is that although we do not have detailed firm-level data on the FDI purposes, however, Korea Export-Import Bank data provides detailed information on outward FDIs at the very disaggregated industry region level. So if the author can merge the so-called KAIST data to survey business activities data, it would help the author to identify the objectives of outward FDIs, I believe. So this is my last comment, which is not directly related to the Dr. Kim's work, but as a trade economist in Korea, I believe this would be our future trade policy FDI issues in Korea. So as all we know, as a result of trade negotiations with the second U.S. Trump government, so Korea promised to make investments of 350 billion to US dollar to the United States to lower import tariffs from the US, and the investment consists of 150 billion to shipbuilding, so-called MASCA, plus other critical manufacturing industries like semiconductor. So from Korea's position or perspective, as a trade economist, I believe that we need policies to reduce negative shocks from hollowing out effect and weakening competitiveness of manufacturing industries. And also we should think about how to raise the amounts or share of flow back, so-called capital reshoring, flow back of investment surplus to the home countries. So they would be our potential future policy issues to study more. So this is my discussion, and thank you for paying attention.
Thank you, Dr. Choi, for your nice summary and thought-provoking comments. So let's move on to the last discussant, Dr. Dong-hyun Park from the Bank of Korea. So Dong-hyun will discuss the presentation without slides.
Thank you very much. My name is Dong-hyun Park from the Bank of Korea. And first of all, let me thank KIEP and IMF for having me here in this very meaningful event. I would also like to express my appreciation to two presenters for their insightful presentations. Thanks to both of you, we now have a much clearer view of Asia's value chains and Korea's strategic response in this era of supply chain restructuring. To me, the common message running through the two presentations is very clear. In a world of geopolitical fragmentation and trade uncertainty, the right response for Asia Pacific is not to close doors, but to deepen integration and diversify strategically. Both presenters from different angles showed that openness is a key source of economic resilience. Let me begin with Dr. Baba's presentation. As you already know that the previous three discussants already discussed very much in detail, so my discussion will be overlapped a lot, so it'll be very brief and simple, okay? Her talk nicely illustrated how trade has been the core engine of Asia's growth and how China has acted as a hub in regional value chains. Using the 2018 to 19 US-China tariff war as a kind of natural experiment, the analysis shows that tariffs did not collapse global value chains, but rather relocated production along existing production networks. Firms adopted China plus one type strategies, and countries that were cost competitive, open, and well-connected captured a large share of these adjustment gains. At the same time, the presentation pointed to the next step. Intra-regional trade in intermediate goods in Asia is already done. But intra-regional trade in final goods still falls short of its potential. Non-tariff barriers and the fragmented architecture of trade agreements remain important obstacles. The quantitative simulations suggest that deepening trade agreements and reducing NTBs could generate non-trivial long-run GDP gains, especially for economies that start with relatively high barriers and are deeply embedded in the global production networks. In other words, there are still substantial gains from making existing integration both deeper and more coherent. Where I find the argument especially appealing is its relevance in its timing. The experience of the tariff war in 2018 to 2019 shows that the supply chains are highly responsive to shocks, and the benefits go to those economies that remain open and well plugged in. So the economic case for further integration, especially intra-regional integration, is strong. But it is hard to ignore the political and security constraints. Many Asia-Pacific countries might be cautious about entering new, deeper agreements because of economic security concerns. So while the recommendation to lower NTBs and raise depths of agreements makes economic sense, but implementation will require political will and trust building among member countries. In this regard, we might think of a gradual strategy using regional fora such as APEC to build trust step by step, and in parallel, expanding participation in high standard agreements such as the CPTPP in the region as a pragmatic way to move toward deeper regional integration. And now, let me now turn to Dr. Kim's presentation. His presentation shows how amid supply chain reconfiguration in Asia, Korean firms' outward foreign direct investment is evolving and what this implies for the Korean economy. He conducts a firm-level empirical analysis how outward FDI affects domestic economy. The results indicate that firms with a target OFDI tend to increase domestic employment and expand the sales at home. In other words, at least in the sample, outward FDI appears to complement rather than erode domestic industrial base. This directly challenges the popular concept of hollowing out narrative. This is a very important message both for academic circle and for the public discourse as well. Having said that, as already mentioned in the end of the presentation of Dr. Kim, I would like to discuss a topic about the heterogeneity of these positive effects or negative effects to be explored in the future research. First, there might be heterogeneity across industries first. In technology-intensive sectors, such as semiconductors or electronic components, outward FDI can help maintain or even expand the domestic capabilities in R&D, advanced design, or supply chain coordination. But in more labor-intensive sectors, such as shipbuilding or automotive assembly, relocating production abroad could possibly, in some cases, translate more into declines in domestic production or domestic employment. Of course, this is just speculation, so this should be tested in the robust empirical test, of course. And this suggests that the domestic impact of outward FDI is not uniform, but depends on where an industry is located in the global value chain. And more detailed sectoral decomposition would therefore be helpful for future policy design. Second, we should think about heterogeneity across host country groups. FDI into advanced economies like the United States or European countries tends to be associated with market seeking and strategic motives, better access to large markets and linkages to sophisticated technology ecosystems, and thus may generate a stronger positive feedback for headquarters in Korea. In contrast, foreign direct investment into emerging economies such as ASEAN countries, even often more cost-driven. And so the spill back to domestic production and employment might be more limited. This issue has become particularly important in the context of recent tariff and trade arrangement with the United States, as already mentioned in the previous discussion, and the strengthening of the supply chain cooperation. There is growing interest in quantifying how the expansion of Korean firms' FDI in the United States affects not only the exchange rate fluctuations and the current account balances, but also domestic value added and employment as well. I believe this will remain a very important question for future research. To conclude, Dr. Baba's presentation offered a macro-level recommendation, and Dr. Kim's presentation provided a micro-level perspective. Taken together, these perspectives are highly complementary. They suggest that regional integration and firm-level adjustment are two sides of the same response to a fragmented world. And for both academics and policy practitioners, the key challenge is to think about how to strengthen resilience without abandoning the benefits of globalization. Thank you very much.
Okay, thank you, Dr. Park, for your precious comments. Now that we've received more than expected comments and questions, so I will give each presenter 5 minutes to respond to some of those questions. So first, Dr. Baba, so why don't you respond to the comments?
Sure.
Thanks a lot for very thoughtful comments. So let me just answer a couple of questions that I received. So with regard to our empirical analysis on the value-added exports impacts, whether the impacts are short run, long run. The fact is that we have, from 2018, we have 7 years by now, so it's hard to say if the impact is long run or short run. It's just that we need time, and by the time we have enough data, probably too much shocks happen. So it's empirically very challenging to distinguish the short run or versus long run effects. But at the same time, these are really the increase in the value added. That means that Vietnam, for example, must have expanded their domestic capacity to produce goods. So in principle, we think this impact should be longer lasting rather than just temporarily transmitting their export from China to the US. On your comments on the export to the world beyond the export to the US. This is very relevant point, and actually our last year's regional economic outlook have a box that actually looked at the gross export to the world. I mean, how the Asian countries gains in the gross export to the world have differed across countries. And generally, patterns are similar to what we saw in the value-added export to the US, while some countries have higher ranked in that picture. So these countries, well, let me not quote any country, but I think for countries that gain, there are countries that gains in terms of export to the world, but not to the US. In these cases, they seize the new opportunities rather than expanding to their export to the US. As for the FDI from China, whether they are escaped from China by the Chinese firms, the answer to my knowledge is yes, there are Chinese multinationals increasing their investment especially in the ASEAN countries. I think that the best reference I can offer on this is the IMS publication on China from 2024. There is a selected issues paper on the FDI from China, and there the China team clearly documents the increase in the FDI from China, which is really a striking trend showing that the Chinese firms increased their investment in the region in the recent years. And with that, we kind of interpret that the rising FDI from China is really indicating that these Chinese firms increase the imports from China to expand their production in ASEAN countries to export to the world. Although this is kind of indicative evidence that we stitch, and it's not a direct test. So I think this is one thing that the additional research can be conducted to directly link these two findings. And there are two comments on the CPTPP. Now, if we compare the regional agreement that are newer in the region, I mean the RCEP and CPTPP, clearly CPTPP is considered deeper agreement in a sense that the CPTPP requires the members to commit to the really commit to the policy agreements, while RCEP is more cooperation-based. So it's going to encourage members to do that, but not necessarily required. So in that sense, based on the past analysis, CPTPP have better scope to deepen the integration because it requires deeper commitment. But of course, it comes with higher cost. And the non-tariff barriers exist with reasons. There are parties that are concerned about the gains or potential lose out from the trade integration. And so separate policy would be needed even if the trade integration at the aggregate level is the desirable policy, that the promoting the membership in TPP will need to be supplemented with the policies to support these parties that may lose from the greater integration.
So, Dr. Kim, so you have 5 minutes to respond.
Oh yeah, thank you. Thank you very much for sharing insightful comments for our discussions. So, for Dr. Baba's comments, I think that your comment on incorporating the extensive margin it will be the core focus of our project. So I fully agree that incorporating both intensive margin and extensive margin is actually required for policymakers to fully consider these uncertainties and some remedies on this like supply chain fragmentation. So, I think that so our technical like hardships were coming from the IV specification. So IV specification only allowed the intensive margin analysis, at least like at this stage. So I think that we should be able to circumvent those issues by employing other like causal inference or other IV strategies so that we can see both intensive margin and extensive margin. And also, and your comment on the purpose of FDI is very like important thing that we have to accommodate because even within the manufacturing industries of South Korea, the purpose of FDI clearly varies. Like even within the same region, such as towards Vietnam, it primarily focuses on the reduction of labor costs, but towards Malaysia or Singapore, they mainly focus on some kind of R&D activities there. So some upstream and downstream specification should be added for full specification, I think. And for Professor Chung's comments, thank you very much for mentioning the issues coming from the affiliated firms, such as some big giant like umbrella firms such as Jaerim. So in the current survey data, the database itself do not have the governance structure such as the stock share and the share relationship between the firms, but it is often public information. So I think that we can make an effort to merge those external publicly available information towards our main data set so then we can derive some insights from the Jaerim's like FDI activities. And for the expression on the expansion of the production network, I think that I should have used other expression. I fully agree with you. So expansion of network should include some like adding more countries within the firm's activities. But my independent variable does not care that adding more countries within the network. So I should have used like development of or some increase in investment towards FDI, something like that. So thank you very much for mentioning that. And for Dr. Choi's comment, and thank you for mentioning the disaggregated like industrial level like Exim Bank information. I'll be very happy to incorporate the intention of FDI using the Exim Bank information, at least in the disaggregated industrial level, so that you can derive some like some heterogeneity within or across industries in terms of the intention of FDI. And also for thank you very much, Dr. Park, for mentioning the heterogeneity across the different industries or different regions, and this resonates other discussants' comments also. So for the me and my colleagues are actually considering some kind of like industry-specific analysis or region-specific analysis by focusing on the southeastern part, the Gyeongsang area of this Korea, or the Ansan Pyeongtaek area of South Korea, so that you can make some direct implication on the hollowing out effect within the manufacturing sector of South Korea. So I'll be very happy to share the results if some insightful thing comes up. Yeah, thank you very much.
Okay, thank you very much for your responses. But I think there remains some unanswered questions. So presenters and discussants, please interact with each other individually after the session. But as a moderator, I have to conclude the session. There was a very fruitful presentation and constructive discussion. Thank you very much.
Today, thank you.